everyone, good morning. You're watching Market Fatafat right here on ET Now, show that promises to point out and flag of all the big movers and shakers in trade today. I'm Mubina Kapasi. Markets looking pretty steady. We are in fact clocking in gains of approximately 75 points, and the gains have only accelerated. We are above 11,900 now for the Nifty, and the Sensex is now gaining 250 points. But for the show, we have with us today Soumya Sharma, ET Now's research analyst, Kunal Bothra, and further on the technicals, Amar Singh of Angel Broking as well joins in on the show. Good morning to all of you. Thank you for joining in. Soumya, let's kickstart the show with a big loser today in trade, Page Industries.
This is the most that the stock has fallen in over a decade. Talking about the Q4 results, which are pretty much negative, and that's what's keeping the street negative about the stock. The profits were down by over 20.4%. Revenue remained flat at over 607.85 crore. Margins saw a sharp contraction from 24.1 to 19.7. In fact, Credit Suisse in their brokerage note today said that they're downgrading the stock to underperform from neutral stance, with the target price being cut from 23,221 to 18,700 per share. Well, they say that growth has further slumped in the quarter 4, and the management does not see a good pickup going ahead in Q1 FY20. Stock reacting sharply, down by over 10.1%, 10.5%.
Oh yes, it's a big decline seen on the stock. Credit Suisse as well has downgraded the stock. Kunal, what is it that you're witnessing in Godrej Consumer? Because today as well, it's gaining smartly.
Yeah, it's gaining smartly. I think there are two price patterns getting found. One is a bullish flag pattern on the hourly charts, but if you look at it on a slightly higher time frame, it's forming an inverse head and shoulder pattern on the daily charts, and the breakout of this pattern is at 680 levels. The stock is very close to those kind of breakouts. I believe with the overall market breadth moving up significantly high, the Nifty also continuing its momentum, I think many of these stocks could complete their breakouts. Godrej Consumers, traders could look at a buy for a target of 700 to 720, and stop loss could be kept at 660.
All right, that's a recommendation on Godrej Consumer. Take a look at NTPC, by the way. Today it's among the top, in fact, it is the top Nifty gainer, gaining approximately 4% in trade. This after the company has delivered its fourth quarter numbers. Yes, there is a downtick witnessed in the revenues, but if you look at the profits on account of the higher other income as well as the deferred tax, transaction, or the deferred tax entry seen in this quarter's financials, the profits have surged, and how. But it's interesting to note that it's the lower under recoveries that has driven the strong performance. Additionally, we have brokerages believing that capitalization will pick up pace, and hence under recoveries will continue to decline. 4% higher for the stock, of course, not to mention operations as well are turning around as availability of coal is improving, and of course the management also expects no fuel related under recoveries from FY20, which will likely boost stability. Let's continue with the countdown then, and after NTPC, Amar L&T, it's usually one of those election sensitive stocks, considered to be as one, and for the last 4 trading sessions the stock has been doing nothing but going up.
Yeah, I would say that if you look at L&T continues to be in a strong uptrend. It was consolidating for a few days. But then after taking out 1370, 1380 levels, because that was a crucial level of resistance, so that taken out, the stock is currently around 1585 levels. And the short-term trend, the intermediate-term trend, and even the long-term trend, what we are seeing is that the stock has broken out of a major resistance zone, of which was earlier around 1470, 1480 levels. So it means that there is further upside to the stock. On the upside, the stock could rally towards 1625, 27 levels, whereas on the downside the stock has support around 1517, 1520 levels.
Okay, so Amar is saying that you can hold on for now, and yeah, those are the levels as well that he's saying one can monitor. More earning reactions then, and Soumya, Divi's Labs too is taking a beating today in trade.
Well, yes, this is one again a stock that's declining the most since September 2017. The stock is falling on back of the negative results that they delivered. The sales were up by 15.5%, but were a miss when it comes to street expectations, and particularly this miss was on all fronts. Even on the profit line, even though it was up by 10.6%, the street was expecting a better number in terms of what Divi's lab is considered. Even this miss was largely in CCS business, and the management has in fact guided for 10 to 15% of constant currency growth in FY20. Not that really great number, the stock reacting to it.
Okay, so that's Divi Labs, 8% gone today in trade. Kunal, Century Textiles, what is it that you're observing over there?
It's a fantastic chart, Mumina, because look at the price patterns over the last, just 1 week itself. From 900 or sub 900 levels, the stock has moved significantly higher to 1050 plus. It's completing a lot of patterns or a lot of breakouts on the longer term time frame, and I'm talking about the weekly, monthly, and the quarterly charts as well. So this is a stock which has extremely strong potential, remaining sideways before a previous week for almost 4 or 5 weeks on a trot, and now we finally see a strong breakout coming for Century Textile. This certainly merits a hold. I think as a short-term play, you could look at another 50 to 55 points as a pop on the stock price. 1100 to 1110 could be an immediate target on Century Textile. Traders could hold if they have positions and trail your stop losses higher to 1025.
All right, so that's the recommendation on Century Textiles. Well, we'll do one thing. We'll just take a very quick break right here on the show. Do come right back for more. Market Fatafat right here on ET. Now let's continue with the countdown then. And JSW Steel today is the top Nifty loser. Remember, it came out with its fourth quarter numbers yesterday during the fag end of market hours, and numbers were pretty good. But today we have CLSA, which is actually having a sell stance on the stock with the target at 225 rupees, as they see that there's been a sharp fall in the EBITDA per ton. But additionally, they also believe that the steel margins will continue to stay under pressure going forward as well, and hence their negative stance. Mind you, it's a solitary sell. Deutsche Bank has maintained a buy still on JSW Steel after the fourth quarter numbers. Nevertheless, the stock is in the red, 1% gone. Amar, yes, Bank, today it's seeing an unprecedented 5% rise. What would you make of the chart?
I would say that looking at Yes Bank, it's more or less consolidation, with the long-term trend still remain extremely bearish for the stock. So any opportunity for those on the long side, they should look at booking profits. So resistance is around 155 odd levels, and the stock has support around 140. So ideally towards 154, 155, one can look at booking profits.
You know what, we'll just take a quick breather right here on the show and connect with the management of Dixon Technologies, which has as well delivered its fourth quarter numbers. It looks like a pretty good set. Yes, there may be some cost pressures, but I think all in all, the numbers look pretty good. We have with us Saurabh Gupta, CFO of Dixon Technologies, joining us now on the phone line. Mr. Gupta, thank you for joining in. Congratulations. It looks like a good fourth quarter for you guys at Dixon Tech. What would you attribute the strong growth number to, especially that top line growth, 858 crore rupees?
Yeah, good morning, everybody. Thanks a lot. I think so. There has been always a focus on adding more customers. So the broad strategy at a company level is to migrate more and more to our own design, keep focus on backward integration, and keep adding more customers. And I think so we have been able to do that across all the verticals. So despite the industry slowdown in consumer durables, I think so we have delivered good growth. Good revenue and good growth on the profitability side, and it's mainly on account of the customer acquisition that we have done. So if you talk about consumer electronics, we have added Xiaomi as a customer, and the order book from Xiaomi continues to look strong. Month on month, our order book continues to grow. As far as home appliances, washing machines is concerned, we have a big order book from one of our anchor customers, Samsung, and that continues to grow. If you look at the lighting segment, I think so today we account for almost 50% of the lighting business in India, and we have all the major customers like Philips, Bajaj, Wipro, Panasonic Anchor, Jaguar, Usha, Siska. So I think so this has been the reason that despite the overall slowdown in the industry, I think so we have been able to grow at a faster rate because we have been able to add a lot of customers in each of the segments.
Okay, that's good to know. Mr. Gupta, I understand that you mentioned washing machines, and yeah, while the growth of that look good, I think the margins in that segment have contracted. If you could just tell us what the reasons for that are, and is that the segment that has put pressure on your overall margins as well? Because that too is more or less flattish.
No, so if you look at the volumes and nothing has changed on that side, I think so there is a one-time expense. There is a stock option expense of around 2.5 crores, and there is an expense of around 1 crores which gets allocated to each of the segments. to home appliances, to consumer electronics, lighting segment. So we need to allocate those corporate overheads. If you add back those corporate overheads, the one-time expenses, the margins would look similar to what we achieved in Q3. So we are in for a strong growth, and I think so the margin should also look better going forward. We should continue to do margins of around 10.5-11% as far as washing machines is concerned. We are doing a lot of value engineering as far as cost is concerned. We are also introducing new models for the anchor customer, which will of course lead to higher margins. And we are in the process of launching a fully top-loading automatic machine as well in 6 and 7 kg category, and that should be up and running by Q4 of the current financial year.
Okay, so margins should also continue to stay strong, should move higher from here on as well. So if I have to just talk about your individual segments and your overall order book. Currently, what's your order book like, and which segment will lead it? Because you have LED TV, you have lights, you have washing machine, and Xiaomi as well. So all of that, which segment will essentially lead growth from here on?
I think so all the three segments. So if you look at the consumer electronic, which is the LED TV segment, we are now expanding. We have expanded the capacity from almost 2.4 million to 3.4 million annually, which is one of the largest capacity that any company has in India. And this will take into account almost 24% of the India's market requirement. So we are not only placed to take care of the increased order book from Xiaomi, but of any other big customer that may come in future. If you look at the home appliances segment, the total market size is around 39 lakhs as far as semi-automatic category is concerned, and we are almost at 11 lakh kind of a number as far as capacity is concerned. So we are almost 1/3 of the total market in India, and we have a big order book there as well. We are also now getting into the fully automatic, as I mentioned earlier. And if you look at the lighting segment, we have now expanding the capacity from 18 million LED bulbs per month to almost 20 million to take care of the increased order book. And we are now also expanding the capacity in battens, which is another form of indoor lighting, to 2 million, which is almost like 40% of the total market size in India. We think in lighting, the FY19 year should be a year where we'll see the expansion of capacity in battens, deepening of the relationship in the LED bulb side, more backward integration, and now we think we are globally competitive, so we will make a serious attempt for the global business as well.
Mr. Gupta, just very quickly, one quick question. I just have to move on as my producer directs me. But some consumer durable guys we've been talking to are saying that there may be a bit of a slowdown. Very quickly, if you can answer, is this something you'd be worried about?
So there has been a slowdown. So post Diwali, there was slowdown for the last 4-5 months, and the main reason for that is, of course, the whole NBFC crisis which has taken place, which has really impacted the whole liquidity in the economy. I think so with the new government coming in, the main priority of the government should be to create liquidity for those NBFCs, because that really has an impact on the consumer financing. I think so once that's taken care of, and once the whole income growth happens in the economy, I think so we are looking for a further growth as far as consumer durable industry is concerned. And I think so the government would also simplify the GST, and you may, in order to boost the consumption demand, we may look for further rationalization of the GST rates.
Okay, Mr. Gupta. Thank you then for joining in and sharing your perspective with us on what happened in the fourth quarter for the company. And in fact, as we speak, your stock as well has spiked. It's now 3.5% higher as opposed to gains of 2% we were seeing in the earlier part of this. Thank you once again for joining in. And from one corporate to another, Lakshmi Cement has delivered its fourth quarter numbers as well. Strong volume growth, however, realizations marginally lower, profit growth of 32%. Let's talk about the numbers with Shailendra Choksi, whole-time director of Lakshmi Cement. Mr. Choksi, thank you for joining in on ET Now. Good morning. Firstly, just take us through the highlights of the quarter, and also, most importantly, the sales volume in the fourth quarter for cement. What was that number like?
In the fourth quarter, we have seen a very healthy jump in our volumes of production going up by close to 33% and sales going up by about 32%. I think that was the major highlight. The realization saw only a very minor change of about 1%. So, but because of the impact of this volume, we could garner some good EBITDA numbers, and therefore we could offset to some extent the 12% rise that we saw in the costs. We have been witnessing and we have been talking about it for last 3-4 quarters, a continuous rise in the power and the fuel cost compared to the corresponding quarters of the previous year, because of which our profitability has been under strain. Otherwise, we have been able to improvise on our volume, we have been able to improvise on our trade non-trade mix, on increasing our PPC, as well as cutting down on the logistic cost, despite the petroleum prices going up.
Okay, Mr. Chok, margins for most companies, for most cement companies have actually gone down. So do you think price hikes is something that is needed to maintain or sort of at least cover up for this cost increase we are seeing?
Yeah, I think there have been increase in the cost all around. So it's not only just specific to us. The industry has been witnessing a steep rise in the petroleum price, and therefore the power and fuel and the logistic. All these three major cost drivers of a cement industry are connected in some way or the other to the petroleum price hikes. So as a result, the industry has been suffering. On top of that, there has been no increase in the market prices in the market in the entire year last year. We have seen recently some increases, but hardly, just barely good enough to compensate for the cost increase that we witnessed in the last year. So I think I will not be surprised if this is a trend that other companies would also see. And but the good part is that these stagnant price and the costs going up, the companies like us, we have been forced to bring about improvisation in our logistic, in our the segments that we operate in, the product portfolio that we have.
Do you think demand increase will lead to a price pickup at this point?
You see, today demand would only be supporting, the prices are needed to offset, as I was mentioning earlier, the steep increase in the costs that have taken place and which are beyond anybody's control. You know, the Indian cement industry is fairly efficient in terms of its power and fuel consumptions. Our own company is one of the, has been in the forefront in these reductions. We are supposedly in the league of one of the most efficient plant in the country. But still we are finding difficult to sustain without any price increase. So I am glad some movement has taken place, and if anything is remaining, that will come in due course of time. The bigger thing now is that this growth momentum must be maintained.
What's the growth in various markets, like especially in the north, like Rajasthan, Gujarat, and even the northern states?
So we have seen on a all India basis a growth of close to 12% in last year, and the last quarter was no exception. In closer home, in the areas that we operated in, like in Rajasthan, Gujarat or northern India, we have seen a growth of about 9%. In the east market, we did see a growth of 10 to 12%, but the states that we concentrate on, in Chhattisgarh and Odisha, the growth was very minor, just about 4 to 6%. And last 2 months, I think the entire country in April and May, we have seen a dip in the very steep dip in the demand. April, while we can justify to some extent that there is usually the labor availability is a problem because the labor goes for the sowing season. The crop cutting season. But that having continued in the month of May, this year is a very big surprise. And though we believe it is partly due to the elections, which affected the investment and the labor availability both, but I think that reason too is now over. So I think very, very soon we should see the growth coming back. But this year, that is the by 1920, I am unlikely to see a double-digit growth as what we witnessed last year, but still a 8 to 9% growth should very much be in the realm of things.
Okay. Do you think that the cost structure is expected to improve, especially with the commissioning of the captive power plant at Durg?
Yes, we are hopeful that this should bring down the costs. Though when we took that decision of putting up the thermal, and today the ground reality has changed because of the increase in the coal price, and therefore even on the captive thermal the cost of power is not very cheap. But going forward, I think as the state electricity grid price goes up, and we continue to get the coal through linkage or auction coal, then I'm quite sure that there will be an arbitrage. We would be saving some cost there. Besides the power cost, we also have been able to bring down further our calorific consumption, the need for the heat value that we need for our kiln operation. There we have been able to improvise, and we have also been able to improvise on our logistic part. So going forward, we expect the good work that we have done, and which we have got part of the year has seen that advantage accruing to us. Next full year, we would expect to see those entire benefit coming to us, and thereby improving our profitability margins.
Okay, so both your plants, the Durg one as well as the Odisha one, once they are commissioned, what sort of operating efficiencies can one expect?
You see, the first and foremost is our Cutter grinding unit, which was slated to have come in this month. We would have normally started the operation in the month of May, but I think that Feni, which came about a fortnight back, has affected the project work. Most of the engineers had to vacate the site. The state had declared an emergency, as you are aware. The power is still disconnected. So water supply, power supply, all has impacted the work there, which is in the just fag end of its commissioning. So I think we have been delayed by about 2 to 3 months. So by July end or by August end, we should see that plant getting commissioned. As far as the thermal captive power plant at Durg is concerned, that we are very hopeful that by beginning of the next month, it should get commissioned.
All right, thank you then for joining in and helping us explain what happened in JK Lakshmi Cement in the quarter gone by. Well, with that, we're out of time, so we'll wrap it up. Thank you for watching. Stay tuned. Markets at noon is up next.